Hey guys, this is Mr. Breen, and in this video I'm just going to compare stocks and bonds as investments a little bit. So if you're a corporation deciding how to raise money, there are various advantages to using stocks versus using bonds. So for a corporation, for someone trying to raise money, bonds have the advantage of being predictable. So you know exactly when you have to make the coupon payments, and you know exactly when you need to pay that money out. And another advantage is that issuing bonds means you don't give up any ownership. So if you already have 51% ownership in a corporation, you don't have to surrender your majority control by selling new bonds. On the other hand, by selling stocks, you do give up ownership and it's not as predictable potentially, but you don't have to pay any interest. So if the company doesn't do very well, the stocks will go down in value, but that, doesn't hurt you any more than it would have otherwise. You don't have to pay interest and maybe not be able to afford it. For investors deciding whether to buy bonds or stocks, well, bonds are less risky. They may not get paid back. It's not a guarantee, but most times they are. And even if the price of the bond changes, then you can still most times hold it to maturity and lock in whatever interest rate you had at the beginning. And in that sense, it's generally more predictable for you what your rate of return is going to be. Also, you might be able to sell it, you might be forced to sell it for a lower price if the interest rate goes up and you have to sell it. But if the interest rate goes down, maybe you can sell it for more than you bought it for, maybe quite a bit more than you bought it for. At the same time, bonds, because they're less risky, because they're a bit more predictable, have a lower rate of return. So, on the other hand, stocks have higher returns than bonds do, generally speaking, and by buying them, you get some ownership in the company, so that's good. But they are riskier, and maybe you don't even want ownership. Maybe you don't want to make decisions, in which case you could buy preferred stock rather than common stock, but still. So, there are ways to try to reduce the amount of risk you take on when you buy stocks. For example, by putting your money into mutual funds. So a lot of you together pool your money in this mutual fund. A lot of investors pool their money in the mutual fund, and then the mutual fund invests in different stocks. So if any individual stock goes down, then the whole fund is not hurt. But still, it is riskier than bonds. I want to stress something here, which is that bonds, though they are less risky, are basically not a very good way to save for retirement. Instead, generally speaking, people are encouraged to put their money into mutual funds and have those mutual funds invest in stocks, because these aren't just higher returns. Stocks can oftentimes offer dramatically higher returns, especially mutual funds. If you're diversifying your portfolio, you can get dramatically higher returns. And those returns are compounded every year. So if you're getting 8% a year on your mutual fund, but only 2% a year on your bond, well, after 40 years, that's a really significant difference. So for retirement, most people invest their money in mutual funds or in stocks.